Hello, everybody. Welcome to the economic update for the month of May. I'm Dean Barber, founder and CEO of Barber Financial Group. Well, one thing's for certain, May was an exciting month overall. Tons of news, lots of talk about trade war with China, lots of talk about this new trade tariff deal that Trump is threatening on Mexico. Markets are in a turmoil for the month of May. Let's take a really quick snapshot of what we saw happen just in the month of May. So when we look at this chart, we can see that gold was really the only thing that did reasonable in the month of May, up 0.5%. And then they got the Dow Jones Industrial Average and the S&P 500 both down about 5.5%. The iShares Russell 1000 Growth down 5.63%. Crude oil down 7%, and then the NASDAQ off by 7.38%. One that we're going to talk about a little bit more extensively here is the yield change on the 10-year Treasury. We saw an 11% drop in the yield change, and we're actually going to get to what that is today. Now, that's the month of May. Obviously, that was not a good month. Let's take a step back and let's look at year to date. So year to date, you see oil up 27%. You see the iShares Russell 1000 Growth up 11%. The NASDAQ up 10.27. You've got the S&P 500 up 9.25%, and the Dow Jones Industrial Average up about 6%. And then gold up just about 3% on the year. But again, you got that 10-year Treasury yield down here down 20% from where the 10-year Treasury was at the beginning of the year. The back up the lens a little bit more, and let's look over the last 12 months. Okay, so May was exciting, but not near as exciting as what we've seen happen over the last 12 months. Believe me, I don't like it. I don't like all the volatility, and I know you don't like all the volatility either. But I think it's here to stay for some time, and we'll get into why I think that's the case here in just a minute. But if you look over the last 12 months, you've got one asset that's in positive territory on a solid level, and that's gold. That's 12 months. And everything else, you've got 0.8% on the iShares Russell 1000 Growth. You've got 0.43% on the Dow Jones Industrial Average, the S&P 500 up about 0.15%. And then the NASDAQ down 3% over the last 12 months. You got crude oil down 10%. And again, the Treasury yield declined by 25.95% over the last 12 months. So the last 12 months, if you kind of took a snapshot of where we were a year ago and where we are today, and you woke up a year later, you'd think it'd have been a pretty boring time. But as you look at this chart, you can see there was nothing boring about what was going on here. You have all kinds of volatility. And again, I think that volatility is here to stay. Here's one of the reasons why I think that. I'm going to take a couple of minutes and explain a chart here. At the top of this chart, I've got the 10-year to the 3-month Treasury yield spread, which means how much higher is the yield on the 10-year Treasury versus the 3-year Treasury. There's been 3 times where it inverted and actually went negative. So this bottom line across here is where we're looking at the yield curve turning negative. So come back in here, 2001 time frame, 2000, you saw this go negative. And every time that this has happened where this has gone negative since 1955, there has been an economic recession that followed. Now, in this particular case, it was a few months later, and the economic recession is noted by this shaded area. Below this chart is the S&P 500. So you can see from the time that the 3-month Treasury went negative as far as the spread to the 10-year, the S&P 500 in this case started to decline almost immediately. And of course, this was through 2001 and 2 and into the early part of 2003, where we saw almost a 50% retracement in the S&P 500. That yield curve went negative again. That Treasury to the 10-year Treasury to the 3-month spread went negative again here in 2006, and it was a little early. There was still some room for growth in the market here, but eventually that recession did come, and then we had a 55 or so percent retracement on the S&P 500. That yield curve inverted again. We talked about this, but it's really, I think, important for you to see it in a charted format where you've got the markets on top of or in this case below what's happening with that yield spread. So we're further than this negative 0.12 today, and you'll see that here in just a minute. But here's where we are today, and this has happened again. And so the question is, at what point does this recession come in? It's happened 100% of the time since 1955. I can't tell you for certain that that means that there's going to be a recession, but a lot of things are pointing towards the fact that we are at the end of a growth cycle. There's nothing to be feared, as I said last month, but it's something that we need to understand so that we can make sure that you're prepared for it. So if we take a look at where the markets are today, we have to ask ourselves the question, is this volatility that we're seeing over the last 12 months, this chart here, is that similar to the volatility that was going on back in 2007, early part of 2008, and back in early part of 2000 and 2001 before the actual recession hit? So another interesting thing to look at here is existing home sales, 30-year mortgage rates, velocity of money, and the 10-year Treasury rate change. And so this is going all the way back to 2000. And you can see this blue line is the existing home sales and how everything really peaked out here in 2006 and 7. Not a secret, crashed down into the Great Recession. And we've seen a decent recovery in existing home sales. But if you look at this chart, you got 19 years here, and the existing home sales are almost exactly where they were back in 2000. You've got the 30-year mortgage rates 52% lower than what they were in 2000, and the 10-year Treasury yield is 64% lower than where we were back in 2000. The one that doesn't get talked about a lot, I've mentioned it in a couple of videos before, is this velocity of money. Now, velocity of money is what causes inflation. It's really what is the engine of our economy. It's how many times per year does a dollar change hand. And you can see that since 2000, the velocity of money has been in a steady decline. And what that's relating to is that the people that have the wealth, the vast majority of the wealth is controlled by the baby boomer generation. That generation is busy saving for retirement, paying off debt, or they're already retired, and they're not interested in spending a ton of money. That's in mass. Now, it's not everybody, but in mass. And so that velocity of money continues to be low, which makes it hard for the economy to really gain a lot of steam. So when you start seeing things like this inverted yield curve that we talked about a little bit ago, and you still have that money velocity declining, it can definitely lead to some concern. Okay, we're going to switch gears here just a little bit, and what we're looking at is, as of June the 2nd, the yields on the 1 month, the 3 month, the 6 month Treasury, and I want you to focus. Here's your 10-year Treasury yield. Here's your 1-year Treasury yield. Your 1 years are now yielding higher than your 10-year. Obviously, so is the 6 month, so is the 3 month, and so is the 1 month. And so we do have definitely this inversion. We haven't seen the 10-year Treasury yield this low for almost 2 years now. And again, when you start seeing that longer-term Treasury decline, it is a sign that the longer-term outlook for the economy is softening. We have it pretty good here in the United States, though. Take a look at Germany. These are German government bonds. They're 1 year all the way out to their 10-year. And you notice this little minus in front of all these. German bonds are yielding a negative return all the way out to the 10-year German bond. Let's take a look at France. France is yielding negative all the way out to the 8-year bond. Let's take a look at Japan. Japan yielding negative all the way out to the 10-year. We wrote a blog here 2 or 3 weeks ago on the fact that there are now $10 trillion that are on deposit with foreign governments at negative returns, which means that people are willing to put their money on deposit with that government and willing to accept less back because they feel that that is safer than anything else that they can do with their money. So that's their safe money ideas. I'm telling you, this is not normal at all to see $10 trillion on deposit with negative yields. So we combine that with what we're seeing with the 10-year to the 3-month Treasury spread that we talked about a few minutes ago. And what it does is it tells us that we should still continue to be very cautious. Don't get caught up in everything that's happened so far this year and just think, oh, everything's going to be just fine. Look, long term, everything always is fine. but you have to always keep in perspective what's happening in the world, what's happening in the economy. Here at Barber Financial Group, we apply all of the different types of investment strategies to your portfolio, and we do it in conjunction with your overall financial plan. And we try to create the portfolios that you have today so that they line up with what your expectations and especially your long-term needs are. I encourage you, keep the dialogue open with your advisors. Talk to them about your asset allocation, understand what the mix is, understand what it looks like. And for the most part, we've come through the last 12 months, and most of our clients, their plans are still showing a very high probability of success. We've seen a little bit of change, but nothing that's been alarming whatsoever. And there's different types of strategies that we run here at Barber Financial Group. We've got tactical, we've got active, and we've got passive. All three of those different types of strategies have done different things over the last 12 months. Some have done better than others. Some have done a little bit worse than others. Typically, we combine those together for the reason to try to smooth out the ride as much as possible. But when you get into situations like what we've been in over the last 12 months, smoothing that ride isn't always possible. But what we want to do is know that we've got things in place to prevent catastrophic losses, which have the ability to destroy your ability to either get to retirement or through retirement. So I encourage you, keep the dialogue open. We're here, give us a call, and make sure that we know what's on your mind. And I'm going to continue to do these videos for you to make sure that we are sharing with you the things that we're seeing. Thanks so much for joining me, and I'll talk to you again in about a month.